Senthil tells me that normally people join in the first 5 minutes. Once again, good evening, everyone. A big welcome to all of you on behalf of the IIT Alumni Club. Our speaker today is Renu Maheshwari. Renu is a registered investment advisor and therefore the right person to talk about how to grow our money. While there are a number of registered investment advisors, there are some things which make Renu very special. And 3 things which make her very special. One, she was the first person to be certified as a registered investment advisor by SEBI. I think that's a rare distinction. No one else can replicate it. Second, she is also quite a hotshot registered investment advisor. Let me explain what I mean by hotshot. She's got any number of awards from very credible entities. And she also is considered an expert by many major investment journals. And you do see her columns and comments, so on, her opinions being published very regularly. And finally, she is also one of the founders of Association of Registered Investment Advisors in India. Finally, I think the most important reason which makes Renu very special is she is a member of our IIT Alumni Center. And as a member, she ran a series of workshops for over 1,000 professional women in Chennai as an IIT Alumni Center initiative. And those workshops were all about how these professional women could manage their monies professionally. So let's now move on to Renu and the webinar. Renu tells me that she has made it very presentation-like, just about 30 minutes or so. So there's plenty of time for questions from every one of you. Renu, over to you.
Thank you, Ravi. As usual, a delight to be here with our fellow IITians. Well, let me start it with a disclaimer. I'm not an IITian, it's my spouse. And by virtue of that, I've been part of the alumni club, always enjoyed it, and a very, very wonderful association that has been there with IIT Alumni Center. Today, we have taken the topic of grow your money, but let me share the presentation that will keep it a little more crisp, else I can keep talking. So what we're talking about today is grow your money, but more than that, what hampers the growth of money? Since July 2020, we can see the markets growing and we assume everyone's money is growing. But there are a lot of things and a lot of people.
Renu, I'm afraid I have to interrupt you. Could you please put your presentation on presentation mode?
Okay. I've just done it. Give me a minute. Okay, I think
we are getting
the presenter view.
Speaker notes
exactly.
as
yes.
well.
Yes. Now, is it all right?
Yes, perfect. Please continue.
Thank you. Thank you. So what we are going to talk about is what hampers the growth of money and what are the factors which drive us towards, I would use the word, making sure that our money doesn't grow. And a lot of us end up doing that. I'm just going to pick one question first before I go ahead. How much of your corpus is in FDs kind of instruments? That means fixed deposit in banks, deposits with post office schemes and company deposits, maybe even debentures for that matter. Can I get these answers on the chat box? A, more than 75%, B, 50 to 75%, C, 25 to 50%, D, 5 to 25%. If I can have your answers on the chat box, that would be great. It will form the basis of our discussion today going ahead. Okay. I'm not going to, okay, Gopal says 5%, Ravi says 10%, Suresh says 5 to 25. Okay, what constitutes corpus? I'm talking about all your financial assets, every single penny. I'm not including real estate in there. We'll talk about it a little later during the evening. Why have I not included that? Manikandan 5%. Okay. Anyone else who would like to share? So I see that we have a group today, only liquid assets. Okay. Okay, so what I see is we have a group today because of the topic, it was grow your money, and we have a group which is more interested in looking at different avenues of growth and have very little money in fixed deposit kind of instruments. That is, most of you are ranging from 5 to 25%. That is the D part, which is excellent. Should it change my course of conversation today? Probably yes. Let me just quickly do one or two things and then move on with a different kind of a topic today. And I would like you all to tell me whether should we talk about inflation now or not. You can just write a yes or no in this particular chat box. Quickly, yes or no. Okay, Sage says yes, we should talk about inflation. How about everyone else? Yes, okay. No, okay, one no, two yeses. Okay, I don't see any more responses. And interest rates, okay. Inflation, interest rates. Okay, I don't see any more answers, so I assume that it's not that irrelevant a topic, and let's go ahead with that. I'm glad that a lot of you don't have a lot of money in fixed deposits, which is a wonderful thing. Now, why we are saying that? Obviously, you don't have the money there, so you. Okay, that is. But please give me a moment. I'm not able to change the slide here. Yes. So we were planning to talk about the wealth eaters, that is inflation, and that's a major concern when people are living off their corpus. That means, most of the folks who have retired from their active corporate jobs or from their active earning assignments, the major chunk of money goes into a corpus which provides them income, first of all. Second is, in India, unfortunately, or fortunately, it has got both sides to it, a lot of money goes into real estate. And that's where we have another big challenge, which the retired people or the people living off corpus face, because the money becomes illiquid. Anyway, today's topic was inflation and how does it eat into your wealth and what can you do about it. So we will quickly go through it and we'll spend more time taking question answers. Someone spoke about interest rates as well, so we will touch upon that as well. Why are we targeting inflation? It's the biggest wealth eater. It's a number which a lot of us keep talking all the time. Inflation, महंगाई बढ़ रही है, inflation numbers are going up, everything is getting more expensive. We all talk about it, but we are not able to comprehend the impact that it might have on our day-to-day living as we grow older and as we continue to live off the corpus. See, there are two things, and a lot of us, fortunately, are also on that other side who need, say, probably, a corpus of 3 crores and have got 10 crores. Then it's all right, even if inflation eats into it, even if, fixed deposits are not giving enough money, it's all right. But then there are a lot of us who probably need that 3 crores or 3.5, 4 crores and have got only 2 crores or 2.5 crores. Then there's a problem. Fixed deposits or inflation will really eat into it. Then there is a third group of people who need, say, 4 crores and have, say, 4.1 crore. And that's where this thing can really hit very badly. That means if you're not vigilant about, is your portfolio able to beat the inflation? When we talk about growth means it has to beat inflation. Otherwise, there is no growth. So we may assume that it's growing, but it doesn't. It's actually in real terms of purchasing power, it's not growing. As simple as that. I put my money of 100 rupees into a fixed deposit. By the end of it year, it becomes 105 rupees. But whatever I could buy with 100 rupees at the beginning of the year now is 107 rupees. So I'm, in real terms, poorer than what I was a year ago. The other issue is whatever retail inflation numbers that we keep reading, CPI, WPI, and all those numbers, most of those numbers are for essentials. Luxury goods have a very small percentage in it. So depending upon your lifestyle, your inflation number can be different than what is being published everywhere. And so it becomes even more, a number which needs to be looked at carefully, because if you run out of money at an older age or you run short of money, there are very few avenues for us to cover or to be able to manage our situation. This is just one of the examples. In 1994, a liter of milk costed us 9 rupees. In 2014, it was 56 rupees. School fees for most of us doesn't matter anymore. Private universities also doesn't matter for a lot of us. But nevertheless, you can see the amount of difference it is now, difference which it made in 20 years time frame. Let's look at what can happen in future. The same numbers extrapolated to future, to say 2034. Milk can become 350 rupees per liter. School fees can be exorbitant number of 25 lakhs per annum. And mind it, school education inflation is much higher. Private university education can be how many zeros? About 1.65 crores per annum. That's a huge, huge impact on your spending capacity. And that's where we come down to this portion of, why do we target inflation at any point in time? So what we do in case, and that's what was our topic decided for the evening, that how do we inflation proof your money or your income so that your lifestyle continues to be what it is and at present, and you have there are no regrets about, how you invested, how you made your money, how you lived your life. How do you inflation proof? What's the answer? Can we have some answers in the chat box? Sage, I think we'll take up these questions specifically after I finish these 4, 5, 7, 6 slides, so that we'll have we can take up all the questions. Yes, Vasudevan says riskier investments. What do we mean by riskier investments? Of course, higher the risk, higher the gain. That's the way to inflation proof. FDs are risk-free. Yes, we assume they are risk-free because we believe they are risk-free. And that's one interesting conversation I always love to make. We think they are risk-free because we are not able to comprehend that risk. which exists, which is inherent in fixed deposits. The risk of inflation, risk of purchasing power. That's a major risk in FDs. So I got only one answer, riskier investment. Yes, that's a way to inflation-proof our monies. But riskier also means I can lose my money, right? If I would show the chart that what happened in March 2020 last year, and it's so fresh in our minds, what do we do then? It's easier said than done. Let's invest in riskier investments or volatile investments. How many of us could do it in the middle of March 2020? Or how many of us could do it even in April 2020, which was the best time in the history in our lifetimes to invest? How many of us could do it? It's part of the corpus only in FTs. Yes, that's right. So how do we manage that part? And that's what becomes the crux of all the discussions. We all know, to inflation-proof our corpus, yeah, we don't know when and how exactly. That's very true, Well, fortunately, professionals like us, we have some bit of an idea, so we are able to earn our livelihood as well. But none of us know. Yes, what we need to do is to be able to comprehend that what exactly means risk and what is the kind of risk that we can take in our particular portfolio. So I'm not taking you through the other slides which I had planned earlier, because a lot of you have not kept your money in fixed deposits. I would rather just talk, and then we can go on with more of question answers. The inflation proofing of your corpus is done, yes, by investing in riskier investments in growth assets, what we call. And that growth assets are, can we identify what are those growth assets? Can we have some answers on that? What will be the growth assets? Equity. I will not include mutual funds in that. We'll come to that separately. Why am I not including mutual funds in that? Equity, yes. Equity is the growth asset, yes. What else? Absolutely. Equity and real estate. Gold is something which we do not consider as growth asset. Gold just covers up the inflation. It is not considered as a growth asset. Rather, gold ensures that you do not really grow your wealth. It will just cover your inflation. Over a long term, it will just cover your inflation. If you look at the data, that's how it is. Because at the end of the day, it's a dead asset. It's just, you can think of gold as a currency which will not depreciate. So that way gold is good, that is not going to depreciate. Over a long term, it will always appreciate, and but it will cover only inflation. When we talk about growth and we talk about wealth growth, that means it should grow. It should grow much more than a fixed deposit will give me or a gold will give me. I'm talking about growth. That means money needs to grow and the wealth needs to get created. I very often we give this example, you hire employees for your office, for your business, or you hire servants for your housework. What do? Do you give them the salary and then say, okay, please, you can sit comfortably here in the air-conditioned room. Don't need to do anything. We'll continue to do what we are doing, and we'll pay you for for hiring you. So we continue to pay you, but we don't make you work. That's what we end up doing when we keep money in cash, gold, or fixed deposits. Housing is part of real estate. So gold is something, which is it's not a growth asset. It is, it's like I said, we hired someone, but we are not, and we are paying them, but we're not making them work. When money is working for us, means money is going to make much more money. So while equity and real estate are the two asset classes which really give us a lot of growth, there are also a big problem associated with them. That is, they are also risky assets. Both of them. A lot of us don't consider real estate as risky, but real estate is very risky if you would have bought, if you're stuck in that wrong cycle. For example, if you had bought any real estate, say in 2012, 13, and look at what we would have made today. I know a few of our clients who bought it in Gurgaon sometime in 2012, 13, they're literally half in value right now, half after 9 years. They're half in nominal terms. You can imagine what about in real terms. Just today, I was, one of our clients had done a deal. He bought a apartment for 40 lakhs in some tier 2 city, and he's doing a deal today for 50 lakhs after 9 years, 2012 to 21. I'm not saying it happens all the time. So, I mean, there's 40 to 50 lakhs, this becomes how much percentage? About 2, not even 2%. So I'm not saying that happens all the time, but I'm saying you look at the risk part, that even if he did not need 40 lakhs, he needed to sell the whole part. You can't, there is a risk of illiquidity. You cannot sell small parts of the real estate. Absolutely, Vasudevan. What you are saying, it cut wasteful expenses, penny saved is penny earned from investment. That's true. Money should be able to support us, our life, not the other way around. Absolutely fine. Sometimes what is a wasteful expense is also something we would love to understand, in our lives, something is a pleasurable expense and we would like to do that. What we as planners, advisors, and investment managers try to help our clients do is live a life that they want to live with the help of managing the money in such a manner that the risk is managed appropriately and they're able to invest in growth assets as well. So the net return is much higher than what would happen if the money was in safe instruments, but at the same time, overall risk of the portfolio is not good. So, I mean, the money should be there to support our life and to make us happy. It's a tool for us to be able to fulfill our life. So that is where we talk about these stocks and real estate. These are the only two growth assets. Now, stocks have got another problem, or the equity has another problem of volatility. So while we all say it's a wonderful asset class, what happened in March 2020? I know a lot of people, I mean, losing the cool that, oh my God, what is going to happen? Where will it go? It looked like a bottomless pit. It felt like the end of the world. And that is something which happens a lot of times in equity market. And that's what has to be managed in a proper portfolio. So when we talk about portfolios, it is that we put these investments in such a manner that the volatility or the riskiness of overall portfolio should come down. That means that if the markets went down by 40%, my portfolio shouldn't go down by 40, 30, 20. Hopefully, I should still have my principal saved. So the portfolios should be tuned to that particular aspect. And that is where you are able to fight off inflation, any taxes that will have to be paid, and at the same time, you're also able to make your portfolio less volatile. What happens when the portfolio is less volatile? Emotionally, we are able to support that investment. So when the markets crashed by 40%, and my portfolio went down by only say 2% or 1%, or for the older portfolios, of course, the principal was still intact, it didn't go down. I mean, it was still not in red. I don't feel jittery. I don't feel uncomfortable. I don't feel nervous. And when I'm confident and I don't feel nervous about all those things, I'm able to take objective decisions. So the biggest thing about being able to manage our investments properly is how do we manage our behavior around it. Now, easier said than done. I can't be cool and calm and collected if I don't know where is my bread and butter gonna come for the next year. So that is the other aspect of a well-managed portfolio. Certain amount of time, and I'm right now tuned into thinking that we are talking about managing our life with the money being generated from the corpus. We are not talking in terms of new investment for now. We are talking about living off the corpus and managing the corpus. So how do we manage the behavior? In what we do is we say, okay, for this certain amount of time, your money is there in safe, secure assets. So for example, 5 years of your expenses is there. Whatever may happen in the world, that money will still be there. Beyond 5 years, let's take chances. Let's take volatility risk. Let's take, sometimes even illiquidity risk, depending upon the size of the portfolio. And why so? Because on an average, things come around during that time. And I'm going to stop sharing this presentation, and I'll just share some data points of a portfolio that we have done for a retired person. And you will see that when we talk about how much money can we keep in equity, and what are we doing at a practical level? Let me just share that. Give me a moment, please. So this is one portfolio. This is she's a retired one, and she didn't mind sharing her data with everyone. So that's what we have put out here as well. 60% of her money is in equity, 31 in debt kind of instruments. That means fixed deposit, debt, mutual funds, company deposits, corporate debentures. 6% in gold, and 3% is in hybrid instruments. We needed to put it for a certain purpose for her. So you see this 60%. Typically, if you look at rule of thumb and people talk about what's the rule of thumb, how much you should put in equity, and then they say, okay, 100 minus your age and put that much in. All that is, only rule of thumb. Just because you are retired or you are older or you do not have current income does not mean you should not put your money into growth assets. That's a thing which it doesn't have any scientific validation to it, because if you look at the reality of life these days, you see most of us start working at the age of around 25. Retirement age has become from 60 to 58, and in a lot of companies 55. And most of the people with good living habits will survive well into their 90s. So then you see 25 to 55, 30 years of working life, 55 to 90, another 35 years you have to live off that money. And you can imagine how much the life will change in 30 years. Because you can imagine what you were doing at the age of 25 and what is the situation by the time you reach your 50s, in your 50s. That is the kind of change that you should be, your corpus or your portfolio should be able to, withstand during your retired life. And that will not happen if you keep your money in safe, so-called safe instruments. We don't consider them as safe because they have a bigger risk of making me poorer day by day and year by year or month by month. Then comes this judicious part that you keep a good chunk of money beyond a certain time, beyond the expenses of a certain time, keep that money in equity or all growth assets, and let them grow over there. So as your money grow, you can keep pulling out from there and use it for your routine things. Now, why do we assume that equity will continue to do well? What is equity? Equity is something where you are investing your money into someone else's business. So you are not running the business, someone else is running the business, but whatever they are making there, they're sharing those profits with you. Plus, then there are the markets. The markets start valuing those businesses at higher level, and they start. So the business that you would have bought, say for 10 crores, is now become 15 crores. So your value of your investment also goes up there by that 50%. The best part with mutual funds, or someone said equity or mutual funds, and that's where I'm going to go back to the slide that I was showing you earlier. In this one, this is the one which we were talking about, mutual fund. Mutual fund is just a vehicle to invest in all these asset classes. That's a very important difference we need to understand. Mutual fund can invest into gold. Mutual fund can invest into equity. Mutual fund can invest into government schemes. Mutual funds can invest into bonds and debentures. Mutual funds can invest into, say, company deposits, and also give loan to banks, bank deposits. So mutual fund is just a vehicle where the money is pooled and then reinvested or redistributed in different asset classes, or a combination of asset classes. So please do not assume that all mutual funds or all schemes will behave in a same manner. From mutual funds, behavior will be different from scheme to scheme, fund house to fund house, of course, but scheme to scheme. Major difference will be scheme to scheme. So what is the underlying asset? That is what will decide upon how will that particular scheme behave, and how much of that scheme, how much of your money should be invested in that scheme. Here I definitely want to bring out one thing which I have seen personally. I have seen that the way this particular product has been sold and oversold to retired people is balanced funds and balanced advantage funds, and that too dividend options of these balanced funds. They were sold as a replacement to, say, fixed deposit or term deposits, and they were told to be, and people were told, let's say, don't worry, your fixed deposit is going to give you 7%, this will give you 10%, 9, 11%, 12%. And what happened when the markets crashed? These schemes were not able to give the money, one thing. Second is, when these schemes give dividends, it's not a dividend like a dividend of share. That means it's not a profit which is being shared. They sell your units and give it to you. And if they've committed as a dividend option, they will actually sell the units, come what may, whatever may be the market. Whether it should be sold or not, in the proportionate manner, they will just sell and give it to you. So don't fall for that. And when we take the questions, if any of you have the doubts, of course, you can always come back and ask us, about these. So that is what, when we talk about how should you keep a portfolio which can continue to grow, at the same time withstand the volatilities of the market and support you for the rest of your life. I think we've already spent some half an hour. Ravi, is it okay we take more questions rather than me just going and talking, giving statements like these?
That's always better.
Yeah.
A lively Q&A is better than...
Absolutely. So let's go ahead and take the questions then.
Could you stop sharing slide?
I will, yes.
We can all open up our cameras.
Yeah. Okay. Friends, we can take questions. I can start with someone was talking about PF and PPF, in which category does it go? See, Provident Fund and public Provident Funds, employee Provident Funds, typically all of them invest in fixed income securities. That means they fall in the same categories like FDs. So it's a debt instrument. That means there is not an element of growth, but an element of interest. What makes these two things, public provident fund and employees provident fund, different than fixed deposits is the tax advantage and the rates that are controlled by the government. So the rates are typically, till now, for now at least, have been much higher than the fixed deposit rates. When the interest rates go down in the market, they don't go down that much. But even when the interest rates go up, the rates don't go up that much. If you would recall 2013 and 2012, when FD rates were 10.5%, PPF, PF was still 8.5%. And right now, when FD rates are 5.5% kind of range, these are still in 7.5 to 8% range. But the biggest advantage is tax-free. But now we have a limitation. We can't really invest a whole lot of money. One thing. Second is growth is still growth. Equity will still give you much higher returns. Does it mean you should not have PF or PPF? No, you should definitely have. But the portion needs to be judiciously divided. How much goes in there and how much goes in growth assets. More questions, friends? You can put it on the chat box and then we can take it from there. Yeah, Gopal.
Gopal has a question. Yeah. Go ahead, Gopal.
Hi, can you hear me?
Yes, Gopal.
Yeah. So basically, Renu, I think you are in sync with my thinking also. Great. That feels nice. I have somebody who's thinking the same way. Because we get lots of advice that once you're nearing your retirement age or retired, so I mean you should not be taking risk in equity. But I am of the opinion that I think, as you said, the rest of the fund, rest of the money, rest of the all the instruments, financial instruments are basically, you just park your money and the value is going down, and there is risk element in equity. Yeah, but I'm little intrigued when you said that you can try to sort of save yourself from some very bad situation like what happened in March 20. How is that possible? I mean, is it possible? Because, okay, I mean, prior to March 20, whatever was the value and what it is today, it is still 50% higher. And but you cannot sort of predict those sort of huge falls. And so how do we sort of safeguard ourselves? That's a little tricky question, but if there are some small tips, it will always be nice to hear from people like you.
The simple tip is, if I don't need that money for next 5 to 10 years, let me shut my eyes and let the world do whatever it's doing at this point in time. See, I look at it in a slightly philosophical manner as well. When this March issue was happening, was it a very easy period for us? Definitely not. I mean, and we are managing so many people's money. But we look at it in a very objective manner. That is, COVID or no COVID, it will not be the end of the world. Human race is resilient. We have come back from worse disasters than COVID. So we would come back. And when you come back and then the human race or economy or anything comes back, it always comes back with a big bang. So how do you protect your portfolio? You definitely cannot predict that. It is impossible for any of us to predict that. What we develop is a resilience in the portfolio to withstand it. It means that it might go down, but you don't take decisions based on that moment, what's happening at that moment. You take decisions based on what you need to have for next 5 years or 10 years. And it gives you a lot of balance of I would use the word behavior. Your behavior gets managed and then your portfolio automatically gets managed. So if a portfolio is less volatile than the market, it's always easier for you to manage your behavior. If your portfolio is more volatile than the market, I mean, that's how we have observed and the researchers have also shown, then it's very difficult to manage your behavior in an objective manner. So that's a very small, simple tip. Shut your eyes. We actually told our clients at that time, if it gives you heartache, don't look at the television. Please watch other channels. Don't watch news channel showing you the stock market, because we don't know where the bottom is. But look at the valuations, and we are going by that, and we believe that things will come back. Now, we did not know if they will come back in 6 months or 1 year. We were giving it a time frame of 3 to 5 years. It just happened very fast. And that is something which was unpredictable, by any of us, the timeline. But we know that how will the cyclicity work. And that's how we built in that, we managed the behavior, I would rather say that. And we were pretty okay with that. Most of our clients did extremely well.
Renu,
yes.
correlate to Gopal's question and your response to that. What you're saying is, some of your money should be money that you don't need for 3 to 5 years.
Yeah.
And you should treat them differently from money you need for the next 3 years, something like that.
Absolutely, absolutely. And that's the reason when you have a portfolio where few assets will be stable, non-volatile, not giving you that much return, but they're giving you security. And that's what it is meant for. So they may not give you high return, but they will give you security. And the rest of the portion will give you growth.
Madam, this is Suresh here. I have a couple of questions. What I find is in the portfolio, you are not mentioned about investment into startups, which there is a good opportunity because there are curated startups which are being offered by few of the angel investors, and you can, which reduces the risk considerably, from the perceived risk normally in that industry, whatever it is. But the returns are quite huge. In a 2 to 3 years period, you get a return of almost 10 to 12 times kind of a return. So that's one part which I was wondering. Second part is there are some funds which give you a kind of a guarantee that they take your fund and they invest it in such a manner that even during volatility of 30 to 40%, they follow a hedging mechanism by which your fund is safe and they are able to give the returns what they promised you. But the money gets locked in, say, 3 to 5 years period. So that's where the whole thing happens. So is this funds good to get into it? Or what is your opinion on that? These are the two things which I want to ask.
Yeah. So the first one, startups. It's a wonderful place to invest money. But when we are talking about a limited corpus of retirement of 3 to 4, 5 crores, we typically do not advocate putting money in startups. See, whether angel investing has happened or first round of, what you call seed capital and second round and all that, the fact remains that startups are a risky business. And the fact remains they are very high return business as well. But if you will look at the percentage of startups which are successful as compared to how many are unsuccessful, then there are more unsuccessful startups than the successful ones. So it looks great because we heard about Zoom and Zomato, Zomato and Zoom and Swiggy kind of thing, but we never get to hear the ones which couldn't even come for first round or second round, couldn't even move beyond the venture or angel investing. Should you not invest? No, I'm not saying no. I'm saying you can't invest your money, which is essentially kept for retirement. If you are in your 40s and have more money than you need for all these essentials, yes, by all means, go ahead and do it. But don't put your essential money into startups. That is what our view is always on these kind of investments. They're excellent investments, but not meant for primary to fulfill your primary need of incomes and retirement planning. Second one was about guaranteed funds and hedging and promising. See, they all these things are strategies which are based on certain assumptions of risk, volatility, and then how much returns will happen. So to some extent, they will be okay. But if the risk continues for a long time, they will not be okay. The example is what happened in 2008. The Black-Scholes model was the basis, and the derivative option pricing model was the basis of their initial valuation. When those models were run, they did not consider the Great Depression into it. They took back for 30 years, 40 years, 50 years, but they did not consider Great Depression. And so when the cycle turned around, the whole thing crashed. And see, COVID in 2008 was a very different situation. COVID was a medical issue for which economies were shut down, and and so we had all the reaction. But 2008 was a market fiasco. The basis of market was, questioned that what about these valuations and how is this money floating around? So what happens is when we talk about these guaranteed funds and all, we always take them with a pinch of salt. I'm not sure which one you are talking about, so we can always take it offline. We always take it with a pinch of salt, and whenever we see these products, we look at it very carefully and then put it, make them part of our portfolios or not make them part of our portfolios.
Thank you, madam. Thank you.
My pleasure. Vasudevan says, for wealth transfer from one to the next generation, is real estate still better than others and cryptos? Okay. See, this is an interesting one, this wealth transfer one. We all would like to assume, and we all feel, okay, we've bought one land or one house, and then, our next generation will live happily in it and they'll really benefit out of it. We are seeing a very peculiar problem now. Real estate, when we say real estate, we are not able to differentiate between land, apartment, an independent house, and commercial property. All these four real estate categories behave in a very different manner. They all have their own risks and returns and rewards. But the biggest thing that is there with real estate, it is static at one place. It is fixed at one place. So the positive thing is it ties you to a place. It makes you feel that, that place is home. I have a house in Chennai, so I feel Chennai is my home. My son feels Chennai is home because he grew up in a house over here. But there is another part to it. Our children are flying all over the world. Our children are living all over the world. If we hand over a real estate to them in inheritance, the possibility is that they will not be able to take care of it. They will not be able to manage it remotely. And that is where we are right now recommending, actually for few of our clients who have got lots of real estate, we are saying, you talk to your children very frankly. What are they wanting in life? What are they looking for? Can they take care of it or not? Because we also see people where, children don't even want to go and see those bungalows. They say, okay, you are looking at it, why do we need to bother about it? And will they be able to do those deals later on? So that's something which you should keep in mind. Second is betting on cryptos for generational transfer. I would definitely not do that. I wouldn't do that. We are not even sure about what is the life of crypto and which crypto is gonna be how long. Some bit of a money, a few lakhs here and there is different, but I wouldn't bet on using that money for generational transfer and assume that it will give a lot of money to my children.
Renu?
Yes, Ravi, please.
This is again a question on your response to Vasu on real estate. Within real estate, can you differentiate between land and an apartment?
Yes.
There are different types.
Absolutely. Land is something which we assume will always appreciate. And objectively speaking, yes, The only caveat with land would be encroachment and protecting the land. And the documents, right documents in right place. So while it will definitely make more money in long term, the protection and taking care of land is a very important criteria. If we come to apartments, the situation becomes just opposite. It's very easy to take care of apartments. You can be anywhere in the world. Most of the times there are housing societies and they take care of it. But after a certain period of time, we would like to say from 5 to 10 years of time, apartments start depreciating. So the value of construction keeps coming down. It's only the underlying value of land which appreciates. So over a long term, return on apartments are definitely not, I would even say not worth it. I would personally never invest in an apartment to grow my money. I would buy an apartment to live or, for any other utility, but I would not invest in an apartment. For maybe, maybe sometimes the pricing is right and you say, okay, let me hold it for 2 months, 2 years and then sell it off, but definitely not longer than 5 years because it will definitely depreciate. There are much better places to invest than apartments. And the new construction is always priced better. Technology is coming up. Apartments which were made 10 years back feel very old and outdated. Okay, sorry, I think I'm missing for wealth transfer.
There's a question from Sesh.
Yes, I'm trying. Yeah.
MFs are not as good as equity, etc.
Yes. See, I'm not saying that MFs are not as good as equity. I'm saying what is the underlying asset class in mutual fund? That is what will decide your return on equity on your mutual fund. So if you say, if it's an equity mutual fund, it's as good as equity. If it's a debt mutual fund, it's as good as a debt. What it is not as good as is, say you invest in a index mutual fund, that is Sensex 30. Or you invest, say, in tomorrow's HDFC or tomorrow's Infosys. You will definitely make more money in tomorrow's HDFC and tomorrow's Infosys. The only problem is none of us know which one will be the tomorrow's HDFC and tomorrow's Infosys or for that matter, MRF. See, if you, at the time when people bought Infosys, they also bought something called Silverline, DSQ Square, DSQ Software. So, those companies have disappeared. So, the return on equity portfolio and return on mutual fund is the same. Return on an individual company stock and return on a mutual fund, equity mutual fund will be different. But the risk will always be lower in a mutual fund portfolio because it's got, by the nature of it, it's got 20 companies. Even if 4 do bad, 15 will still do good. Will and appreciate if the population growth slows down or even if it becomes negative. I'm sorry, I didn't get
question on rates.
Okay, interest rates. Right? See, the interest rate, we believe for now, right now, interest rate cycle has touched its bottom. We don't expect interest rates to go down from here. We expect them to go up from here.
The population growth rate, if it goes down,
okay,
the real estate price come down.
See, real estate has its own cycle, will have its own cycle. Rather. Land is something which is limited. See, if you go by the economics, demand and supply, there's only this bit of land in India. So that land will not...
If the population goes down, the number of people chasing the land also will go.
But if you look at it, yes, our growth rate will go down. I don't foresee population...
Already, population growth rate is already going down for the last 10 years.
Exactly. So the growth of population will come down. But overall population coming down, I think we are quite far from there as yet.
So why is this real estate stagnating for the last 7 years? It's a cycle. You can't say it's a cycle. It's more than a cycle. It's
Yeah,
more than
it
almost
is.
7 years.
Yes. See, two things. One is real estate cycle will always be longer than equity or other economic cycle. It's longer highs and longer lows. But the bigger thing is, why did real estate go up? And how long did it take to go up? Real estate went up from 2003 to 2008, 9, 10, like crazy. Actually, from 2003 onwards, it started going up like crazy. The biggest reason was the kind of money which was coming into real estate. Now, once that money got stifled, there was no way that it could have come down. I mean, it could have gone up. And when the real estate went up, if you recall that period, the up to 2008, there was economic growth. But then beyond that, economic growth was not there. So you and I were not making more money, but real estate was going up higher and higher because of a certain kind of money coming into the market. So the real estate went out of reach of people. Now, once that thing happens, there's a huge gap between affordability, demand, supply. And that's the reason why, once that thing got stifled and the kind of money which was going in went down, and to a great extent, a lot of loopholes were plugged in, it just couldn't go up. And everyone is sitting on huge inventories, including builders. So even when some bit of demand would come in, that there was enough and more supply to absorb that. Then there was a third thing of loans, easy loans, tax benefits, and everything put together that all just took the real estate up. And that's the reason why you saw a longer lull in that cycle as well. For now, we foresee a good cycle, good run up now for the real estate for next almost 5-6 years for two reasons. One is it was a long lull cycle. Second is all the houses have become affordable for people, incomes have gone up. And so the construction activity is also going to pick up. Yeah, Gopal, you wanted to say something?
Yeah, actually, I have two questions, one regarding real estate and one regarding equity. I hope I can ask both of them.
Please.
Yeah, the real estate, you mentioned it's a cycle. It's you think that it is on the upward trend now. But my feeling is that, the money that was chasing real estate, I mean, almost like 50% of it has been cut off.
Yes.
So I think there is going to be really a big struggle in future. How the liquidity is going to chase the real estate. So because almost 50%, I mean, that's how the ratio was in the former times. So that part of it has been strangulated. So my feeling is that it may not really go up to the levels that has been in the past. Yeah,
I agree with that part. See, there will be a growth, and probably this is more rationalized. It will be a more rationalized and a cleaner industry now. But we won't see those crazy growths which we saw from 2003 to 2010-11. I don't foresee that. We might foresee that in equity now for a decade. We might foresee very good growth we might see very good growth in equity for next decade if the policies come through, if the things keep happening the way they are. We've been trying to disinvest Air India since, I don't know, 2 decades. Yeah, almost 2 decades now, 2001 to 2021. So the move, if all these policies play out, we will see growth cycle of, one huge growth cycle of 10 years or more than that.
My question on equity is basically, what do you think should be the size of somebody's portfolio? How many? I mean, I invest directly in equity. I don't go through mutual funds. I mean, very little is in mutual funds. So, what do you think the number of stocks you should typically have in your portfolio? I mean, there is the de-risking factor, how much percentage you can have in one company, for example, maximum and the average.
See, what you're doing while you're buying equity and investing into direct equities, you're doing the job of what a portfolio manager usually does, buying, selling, holding, and all that. Now, how much you should have in one company will depend upon how you want to, what is your belief in that company. So I'm assuming you are able to do that research and then buy and then hold and sell or do trading in between based on the technical charts. That's how you are able to get real good returns out of equity. What should be the percentage of individual equity stock in your overall portfolio? That will depend upon what's your forecasting about that particular stock. De-risking, mutual funds have a mandate, they can't invest more than 10% in one equity in a particular scheme. So maybe you can also take that as a parameter. But then that's the advantage, you have, if you can manage all those schemes and all the stocks and watch them, then it has to be your call.
Thank you.
There was one more question about ETFs versus mutual funds. And see, ETFs are exchange traded funds. They are similar in terms of that they de-risk your investments, being able to invest in a lot of companies put together. Right now in India, there is still a limited supply of limited variation in ETFs, but they're coming and more are coming. See, you can buy and sell them on the stock exchange, and that gives you more leverage than as compared to mutual funds. But they're not, a direct mutual fund is not very expensive as compared to ETF. There's a very small amount of expense ratio which goes on if you are investing through a mutual fund into an ETF. And there are lots of ease of operation. For example, you can do regular investment, monthly investment, weekly investments, all that stuff, which you cannot do on ETF directly. So, both the things can be used interchangeably. It's not that mutual fund is more expensive. Actively managed mutual funds are more expensive. Vasudevan, when we say most mutual funds do not beat the indexes, if you are investing, say, in large cap mutual fund, actively managed large cap mutual fund, it cannot beat the index anymore. It is, we have reached that maturity in the market now that actively managed large caps will not be able to beat the index, which are all large cap companies. But if they, most of these mutual funds who claim to be able to beat the market or the index, put an element of mid cap and small cap in their overall portfolio, and that's the only way that they're able to beat the market. So it's a series of evolution in the market and in investment space which is happening right now. That as the markets become more and more mature, active fund managers will find it very difficult to beat the index. That's what has already happened in the West. In India, we still have a lot of alpha, what we call, in small and mid cap, but none at all in large cap. REIT better than direct real estate? It's just like, do you want direct equity or direct mutual fund? The best part about REIT is that you can invest a smaller amount and it gives you liquidity. That's the major difference as compared to investing directly into a real estate. But nevertheless, it's a good way to get an exposure, especially for smaller clients. What I feel is in India, most of our age group, all of them have so much of real estate that REIT should not be even considered. Yeah, Vasu, that's what I said, large cap Nifty ETF, you can also go for index fund. Direct index funds are very cheap, 0.1 or 0.2, 0.49% kind of expense ratio. Not 0.49, 0.2%, 0.15%, that kind of an expense ratio. So depending upon your convenience and how you want to invest, you can consider both of them alternatively. Expense-wise, it doesn't make any difference, hardly any difference. I think.
Thank you, everyone. Thank you, Renu. We
My pleasure.
overshot the time by about 10 minutes, but just pushing the envelope a bit. You know, Renu, in your talk in the beginning, you tended to talk of taking the entire portfolio's returns, right? And you said various things. But in the Q&A, I see most of the questions about returns of individual elements.
Exactly.
How do we put it all together? And if you can put it together and we can wrap up with that, if it's okay with everyone. Over to you, Renu.
Yeah, thanks for pointing that out, Ravi. And that's something which we always see, that everyone asks, "Paisa kahan lagaye?" You know, where should I invest? Which is the next multi-bagger? Which asset will give me more money? But the focus needs to be what will make more money, what will create more wealth for you. And that will be your strategy, the strategy of how much is in which asset classes. Remember, there are only 4 asset classes: equity, debt, real assets, and derivatives. Derivatives is as good as betting, so we are putting cryptos into the same category right now. Then we are left with 3. Real estate, most of us have a lot of physical assets, real estate. So we are usually in our conversations, we keep them out. So now we are left with debt, equity, and gold, 3 assets. There has to be a decent balance between the 3 of them, which will give you long-term superior risk-adjusted returns. It's what we talk about. So at any point in time, when you're looking at that, okay, this stock gave me great return, good, but what about your overall equity portfolio? Did it give you good return? What about your overall portfolio? What return has that given? And that is what should be the parameter in your mind. How do you decide that? That is dependent upon how much risk you can take. And how do you decide that? Simple rule of thumb, if you want to see, is next 5 years are safe or not. Beyond that, I can go in equity. And put them both together, that is debt, equity, and third is gold, because gold will give you stability even when everything goes down. So with all these 3 things put together, you can always have a steady growth of portfolio. Very steady is the word I would use. So even when the markets went down by 40%, your portfolio will not go down by, forget 40%. I mean, most of our portfolios, like I said, didn't even go down by 3 to 4%. The maximum one portfolio went down by 4% for us, which was only 1 year old. Other portfolios did not go down that much. So, Ravi, does it answer the question, or should I elaborate it more?
Not a question, it was an observation. With that, do I have everybody's permission to bring the webinar to a close?
Thank you, Ravi. Thank you, Renu. Yeah, it was wonderful.
Thank you, Gopal. Nice to be able to talk to all of you.
So big thank you, Renu.
My pleasure, Ravi. It's always a pleasure to be able to come and talk.
Some of us may take the liberty of contacting you through Senthil.
Please, most welcome.
Please bear with us. Okay.
Most welcome. Thank you very much. Have
So
a nice
good evening
evening.
to all of you. A big thank you on behalf of all of you to Renu, and
Thank you very much. Thanks. Bye-bye.